and he's currently the McKinsey professor at the Santa Fe Institute, where he studies economics and financial markets. And he was telling us yesterday how he in fact still moves between the two. Anyway, he will talk today about the low intelligence approach to economics. I think an appropriate title for this venue. Simple laws relating order flow to statistical properties of markets. Thank you.
All right. So you're probably wondering, maybe it's a bit odd that we have two Los Alamos physicists back-to-back speaking to economists here. So maybe I should say a little bit about the quirks of fate that brought me to be thinking about this subject as a physicist. As Eve said, I spent 10 years at Los Alamos. I started the complex systems group there, but my background was in dynamical systems and chaotic dynamics, and in particular that got me into time series forecasting, nonlinear time series forecasting. And we were forecasting things like ice ages and sunspot cycles and so on. And every time I would speak about this, somebody in the audience would say to me, well, have you applied this to the stock market? And as I approached the 10-year point, I realized at Los Alamos they were going to give me a little nut dish commemorating my 10 years of service, and this caused me to have a midlife crisis. So instead of buying a red sports car, I started a trading company. And so when we started this trading company, we began using our time series methods, applying them to price series and volume series and things like that, and trying to make predictive trading models. And then at a certain point, we had some models that we thought were doing something reasonable. We had a variety of models, and we said, well, gee, maybe we should go find out something about this economics business. And so we got some books on finance and looked up things like portfolio theory. We said, aha, that's what we need. We want to combine these things together. And so we tried that out, and we discovered it didn't work at all. And then we saw, I began reading the book and said, wow, there's a lot of interesting stuff in here, like the capital asset pricing model. Let's try that. Well, that also didn't work at all. And so that got me interested in, well, what does work? And it set me to reading this literature and thinking about what was going on in it. And I discovered, and this is actually maybe a conclusion after 10 more years of thinking about it, the things in the financial economics world that do work are, for example, options pricing. It's a classic example. It really does work. Mortgage pricing. I have my friend John Giannakopoulos, who I'm actually writing a review paper, I hope someday to finish, on sort of critical analysis of efficiency and equilibrium and other ideas in financial economics. It's interesting, John and I have kind of went along in parallel. John he wrote the entry in the new Palgrave's Dictionary of Economics on general equilibrium. So he comes from exactly the opposite school that I do. We've spent the last 5 years really debating what equilibrium is good for, what it isn't good for. And an example of where we're coming from is John also runs a hedge fund based on exactly the opposite set of principles of ours. Ours is just, let's look for patterns in data, and ours being prediction company, Norman Packard and I started it in 1991. Ours is look for patterns in data that appear to be statistically significant and trade those. Don't worry about where they come from. John's is, let's make a model of your typical homeowner, and when that homeowner will mortgage their house, decide to remortgage their house. And so he has these decision trees. It's just right out of the economics textbook, except there are some detuning parameters for irrationality. So we've had this debate coming from opposite sides of the spectrum, both making successful hedge funds. And I'm quite convinced it works. In fact, I invest my own money in John's fund. So just to show that I do believe at some level that equilibrium models can be valid, I put my money on the line. Hedging also is a very useful thing. Prediction Company actually makes substantial use in that. And using portfolio theory for hedging is a very different thing than using portfolio theory to actually optimize your profits by having the right balance between winners and losers, which, as I said, doesn't work. Now, because of statistical estimation problems. But I'll comment, by the way, that the most useful thing by far for Prediction Company is exactly what's not supposed to be useful. There's this sort of third-tier literature in economics that's sometimes referred to as anomalies, or because most of it's about stock anomalies. These are papers that say, well, if you look at this effect, like if you invest in January, you make a better profit, or if you buy following a positive earnings announcement, the market will continue to go up after that. I've just listed a couple of examples of ones that, well, the January effect probably never worked. The buy on an earnings announcement worked until about 98, and then it evaporated. But in fact, there are hundreds of papers in the stock anomaly literature. They're all published in more obscure places because, by definition, they don't work. But that's what we found by far to be the most useful thing, because while most of those papers are bullshit, about 20% of them actually have something to them. And while none of them are tradable by themselves, if you take the entire literature, sort out the ones that actually work, combine them together intelligently, you actually can make something work. And so I just told you our strategy. But as I said, it set me to reading economics, and the reason I'm here is because, of course, when you're a kid, you want to learn the things that seem to be most well known. Once you're a grown-up, you realize the most fun things are the things that are least well known. And so, being a physicist, I view this as an opportunity. Now, why economics is hard, I mean, I probably don't need to tell that to most of you, but it's because it involves people. Of course, that's what makes it challenging and interesting at the same time. And in particular, you have to have some model for the way people behave, and you have to have some model for the way they interact strategically. Now, the standard solution for dealing with that is to assume everybody's a selfish, rational utility maximizing agent, and that you have some kind of equilibrium. And I think that's actually a very sensible start. As I said, sometimes it even works quite well, but there are many cases where it doesn't work, either because the people aren't really so rational, which, in the context of rationality economics might mean they're really not omniscient. They don't have this view of the world that incorporates all the information about everything, that you may have a lack of equilibrium. And a point I think is underrated is that the models that you get are extremely cumbersome. I mean, anything you do as a theorist, you have to work hard to get the things that you attack. And if you work really hard attacking these issues up here and bringing things into some kind of a strategic Nash equilibrium, then you've typically thrown a lot of other stuff away, like dynamics, or the kind of things I'm going to address here, feedback. And so you're making a trade-off, and really what I'm arguing for in this talk is adversity. That is, maybe sometimes it's good to just take an alternative approach, even if it's just as crazy as the thing that you're making an alternative to. And certainly there's no easy fix for dealing with this problem, and you have to avoid getting lost in what Christopher Sims called a wilderness of bounded rationality. People are so complicated. The ways in which they're non-rational are complex and idiosyncratic and difficult to characterize. And if you're going to stop your research agenda until you have a complete model of human psychology, you're probably dead in the water. So I'm going to investigate an alternative here. It's to use extremely simple agent models, in this case just random behavior to probe a market institution, to then use it to understand what market institutions do alone. And I think one of the things we tend to not appreciate is what powerful things market institutions or our social institutions in general are. I mean, social institutions are things that have evolved over thousands of years that we've structured to allow us to not have to think so hard or be superheroes and still do things that are very effective. And so I think one of the things that we'll see out of this is that by understanding what the market institution is really doing, how it's constraining our behavior, we can win. Now, then this random agent model can be used as a benchmark to understand what agent intelligence really does, how does that really affect things, and we can gradually introduce simple forms of intelligence sort of incrementally to try and do a better job. Now, this is a little bit like a joke I made up of, well, how does an economist play chess? How do two economists play chess? Well, they draw for white or black, and then they look and see what piece they got, and then they spend the rest of their time arguing about whether the Nash equilibrium for white or black results in white or black winning. How how do two physicists play chess? Well, they just randomly move the pieces around the board and argue about the scaling laws associated with that. And so I'm going to take the latter approach. Of course, neither of those is a very good model for how to play chess. I mean, if you move the pieces at random, you have a hard time ever producing a checkmate. On the other hand, if you incrementally, first, it may actually, if you study the properties of that, maybe you can find out something about chess, and you can, of course, build up to higher order models, and that's, in fact, more or less the way something like Deep Blue does chess, is to make, investigate first 1 move ahead, 2 move ahead, 3 moves ahead, systematically investigate all possibility, which is roughly like moving at random, and then having some score function to score how those things go. Now, I want to emphasize that I'm not the first person to ever think about this approach to economics. Certainly goes back at least to Herb Simon, who had a lot of really interesting ideas in many domains along those lines. Gary Becker, who showed that the slope of supply and demand curves could be gotten simply from the budget constraints. Goody and Sunder have some interesting work showing you can reproduce economic experiments you can get actually a fair approximation of what goes on by just assuming that you have random players. And physicists starting into the story, although Herb Simon was sort of an honorary physicist, but Per Bach and Maya Paczewski and Martin Shubik on a paper that's actually in some sense the precursor of the model that I'll show you here. Now the question I'm going to address is what changes prices? What drives the changes in prices? And most of you probably know the standard story goes more or less like this, that you have expectations about future earnings that are driven by new information. So somehow we all have a model of the world, the new information flows into the room, we all evaluate that new information, that alters our expected earnings, changes our fundamental values, and so we do something, normally I don't worry too much about exactly what we do, and we're going to worry in this talk a lot about what we do, to get the prices adjust to reflect that new fundamental value, and then prices are unpredictable simply because, unless that new information is, if the new information isn't random, then it wasn't new because we would have already known it. Now, this has been called into question. I'll just briefly mention this paper by Larry Summers or Cutler-Perturba and Summers. What they did was to take the moves of the American stock market, the S&P index, from 1946 to 1987, to rank order the moves, percentage moves by absolute value, take the top 100, so we see the ranking here, we take the size of the move here, we see the date of the move in this column. They then took the top 100 moves, went to got the New York Times out of a library and copied a couple of phrases out that the New York Times' best shot about what seemed to drive the move. And so if you take the top entry, October 19th, 1987, worry over dollar decline and rate deficit, fear of U.S. not supporting dollar. Now, are those things news? I can tell you as a market practitioner, I never went through a single day without experiencing worry and fear. And if the person managing your money isn't that way, you should take the money away from them because if they aren't worried, they should be. And in contrast to real news like outbreak of Korean War, Eisenhower suffers heart attack. So you can see there is some, quote, real news on this panel, but the real news is actually in the minority. The other things, you'll notice certain patterns. One of them is that an awful lot of these moves occur in roughly the same times. 5 out of the top 12 here occurred in October of 1987. 2 of the other ones occurred in September of 1946, in fact, a few days apart. And you can actually see the decline in journalism when you see that in 1946 they had the courage to say things like, no basic reason for the assault on prices. So the point is, news, while it does seem to have something to do with market movements, it seems difficult to believe this story here based on that. And this has been now sliced many different ways, many studies, all of which show, yes, news has some correlation with large market movements, but it doesn't seem to be something that you can say explains them by any means. I guess another thing I think is that people are quite good at responding to the direction of news. That is, if Putin had a heart attack, then I think we could mostly guess which direction that's going to drive the ruble. On the other hand, if Putin has a heart attack, where should the new value of the ruble be? And how is that affecting things over the long term instead of the short term? I think that's a very hard question. And I think actually the community of investors does a pretty lousy job at anything relating to absolute levels of price setting. This is a famous slide by Campbell and Schiller showing at least that it's hard to make the argument that fundamentals and prices really match up. They compare in the dashed line here on log scale to the solid line. Sorry, the dashed line is some measure of fundamental values. They actually tried many different measures. This one's based on dividends. And the solid line is prices. This is of some pseudo Dow Jones index. And what you see is that the two things can be out of line. They can be out of line for at times decades. And they can be out of line by factors of 2. So there seem to be sustained problems in making prices match fundamentals. This may be because they just don't understand the right way of assessing fundamentals, but the mere fact that we have no clear way of doing this illustrates there's some problems with testability in this theory. In fact, this is generic to theories about equilibrium. You have to know things like what is somebody's utility function, what is the proper measure for information arrival, and these things are difficult to determine even after the fact. Now, to jump into what I'm going to do, or begin to jump, well, the famous theory that's used for things like option pricing is that prices describe a random walk, due to Bachelier in 1900, 5 years before Einstein introduced the random walk model to describe the photoelectric effect. But one of the striking things that isn't known about, even in this very, very simple model of prices, is what is the diffusion rate? That is, what is the volatility, the rate at which these prices jump around, what does that depend on? And another issue that I'll say something about is why do price changes have fat tails? That is, a normal random walk is a good starting model, but it's more complicated than that. It seems that large steps in the random walk are more common than they ought to be. And so why is that true? Just to note that volatility changes all the time. We already saw that out of the largest 12 moves, 5 out of the 12 were in 1 month, 2 out of the 12 were in another month. That wouldn't be very likely to happen at random. Here we see volatility plotted over more than a 100-year span, where volatility is the standard deviation of daily prices blocked into months. So month by month, we take the standard deviation of the prices in that month, plot that standard deviation, and then just plot it against time. And you see there are periods like the Depression where things are extraordinarily volatile, other periods where prices are much less volatile. Can we get some idea, maybe not of the ultimate cause of this kind of thing, but some of the intermediate drivers for what is going on? So my goals in this talk are going to be understand risk, price volatility, liquidity, that is the impact of trading on prices. If you walk in and trade 1 million shares of something, how much do you expect it to push the prices around? And transaction costs. How different are the prices for buying and selling? So how large is the friction in the market? And we're going to do this by investigating the mechanics of the continuous double auction. Now, it's called, first of all, double auction because there's a price adjustment in the orders both to buy and to sell, and those are both adjusting simultaneously. It's continuous because orders are being placed all the time, and prices, transactions can be made anytime there's an update where buying and selling cross each other. And this plot shows the representation that we'll use. We'll represent the volume of buy orders on the negatively here, the volume of sell orders positively here, and prices along this axis. In fact, when I say price, I'll usually mean log price. And the distance between the best buying price and the best selling price is called the spread. The best buying price is called the best bid, and the best selling price is called the best ask. So this is the representation that I'm going to use to think about this. And we're going to make a simplification that there's essentially two kinds of orders. Orders that cross when they enter, and orders that don't cross. So if an order crosses, it's called a market order. It amounts to saying, well, as soon as it crosses by a lot. So, and this is in fact reflected in what people actually do when they're trading. If you submit a market order for 1,000 shares, that means I want to buy 1,000 shares, I don't care what the price is, just sell them to me at whatever is the best price available. In contrast, the limit order is you say you want to buy or sell, but you specify a price, and you only make the transaction if you can achieve the limit price that you put on that order. So, so you can see that the program here is to investigate how prices are being formed in a kind of microscopic way. I sort of apologize in SFI talk. It's sort of overtly reductionistic. But the idea is to go down to this molecular level and then build back up. So just to reiterate what I just said a moment ago, if a patient trader can submit limit orders, say to buy, and there were a couple of limit orders to buy that just kind of randomly arrived at a couple of price levels, or to sell. Now we see the limit orders to sell arriving. Or we could be a little bit aggressive and submit a limit order in the middle of the spread, in which case we'll now update the new ask price. And by the way, I urge you to stop me if anything I'm doing here isn't clear. So I know that people haven't been asking questions, but if this isn't clear, ask me questions. One can also submit a market order. A market order we see arriving there, and as the market order arrives, it crosses, or when it arrives, it crosses with the existing limit orders in the book, and every time it crosses with an order, it results in a transaction, in a trade. So we just saw a trade at that price, there's another trade at that price, another trade at this price, so there are 4 trades altogether, and we can see that the arrival of that market order pushed the price up, at least it pushed the best selling price up, leaving the best buying price where it was. But it's in fact, at the microscopic level, it's the arrival of orders, the cancellation of orders that always change prices. Ultimately, it's not just some change in expectations, it's the mechanical order arrival that literally changes prices, driven presumably by a change in expectations. Now, at an intermediate patience level, one could submit a limit order that crosses the best price, which results in a series of transactions. We just saw 3 transactions. In this case, leaves a residue. For the purposes of the model I'm going to show you, we'll treat that as a market order followed by a non-marketable limit order. So just to simplify things, it turns out that's not a very important effect. And then finally, one can, you can decide you want to change your mind and cancel orders. So pick out some orders. Somebody says, I don't want to do that anymore, and they cancel them. Now, we built the simplest model we could think of to try and get at these 3 processes and the way they interact. And so these are my collaborators. Julia Iori, by the way, is actually a physicist, but she's a financial maths professor at King's College now. Eric Smith and Supriya Krishnamurti were both postdocs at SFI. Eric's now on the faculty. Marcus Daniels is our software guru, and Laszlo Zsilmo is a graduate student. So here's the basic model. It's very, very simple. It's the simplest thing we could think of that we thought we might be able to solve. And we made it in advance of looking at the data. So we see the same representation here. We've got volume of sell orders and buy orders here. And here's the price axis. And so the model is very simple. We assume that limit orders rain down from the sky like manna from heaven. So we have some boundary that determines where they can rain down. In particular, if a limit order were to cross over the best bid, it would be a crossing limit order and result in a transaction, so we don't allow that. We only allow it to rain down at prices larger than that. Similarly, buy limit orders rain up, and again, if they cross the best ask, they wouldn't be limit orders anymore. They'd be market orders, so we let them only arrive randomly down here. We have let market orders arrive at random, and notice we have different rates for these things. We have the same rate for buy and sell limit orders. We have the same rate, but different. For market orders, we have a different rate, but it's the same for buying and selling again for arrival of buy and sell market orders. And then we also have a rate of cancellation. We also have a rate of cancellation, so the orders are also just evaporating. So it's kind of like, in New Mexico, you might not know that most of our snow actually evaporates without melting. And so it's like a one-dimensional world in which it's snowing, the snow is evaporating, and there's this interface in the center where there's a big vacuum cleaner sucking this snow up. But it's dynamic in that the boundary conditions for order placement respond to price formation. So the key thing that we're capturing that's actually very hard to capture in equilibrium models in the market microstructure literature is the feedback between order placement and price formation. This is actually, in a certain sense, an extreme version of the notion that prices are informative. Prices in this model are completely informative because all the traders do is respond to where prices are formed by changing the boundary condition of where we place prices. Where we place orders. Now, you'll notice this is a very ad hoc and arbitrary distribution for order placement. It's not quite as bad as it seems, though, because if an order falls way out here, it's like Bishop Barclay's tree falling in the woods. I mean, it lands out here, and it evaporates, and it never affects prices. So if we only plotted the distribution of orders that are eventually executed, that actually gives you a quite reasonable looking thing that's peaked towards the center, which is what the real data looks like. And I'll come back a little later in the talk to say more about what the real data looks like. Now, so as I said, it's a very simple model, but actually quite hard to solve because it's really a queuing problem with two queues. The queues are dynamic. They have dynamic boundaries. They're influencing each other because the buying limit order, sell market order process determines the best bid, which influences the boundary condition for the sell limit order, buy market order process, and that's all coupled to this evaporation process. So as a physics model, it's actually quite hard. And in fact, I should mention that one of the ways we solved this, Supriya Krishnamurti had been studying sol-gel transitions involving evaporation deposition problems, where she was doing something that was actually a much simpler version of just what we're doing here. Now, without going into any of the math or boring you with too many details, let me just give you an overview of some of the things we've done with this model. One of the things we did is use a physics engineering trick called dimensional analysis, which allows us to both simplify the analysis of the model and actually make first cut predictions. And I'll come back and say a little bit about what those are. But it was kind of exciting because, normally we're brought up to think in physics of length, time, mass, charge. These are sort of sacred things that everything is built out of, and that knowing that the world is built out of those things, we can actually guess formulae and so on. Well, we do the same thing here, except the fundamental things are price, shares, and time. And I'll say a bit about that. It actually turns out it's useful in that, for example, we get a different notion of time. Economic time in this model is determined by the typical cancellation rate. And so any time interval you look at divided by the cancellation rate gives you a rescale time that turns out to simplify things. And I'll show you something about that, very much in the same spirit as Jeff's talk. We're also able to use mean field theory, which is a very fancy word for a kind of crude approximation technique we use in physics. One of the big differences between physics and economics is in physics we don't prove theorems. We just learn to approximate things. And simulation, so we came up with scaling relations, kind of like the ones that Jeff showed you before, and so we'll now actually test these against some real data. So my colleagues on this are Ilya Zovko and Paolo Patelli, both graduate students at Santa Fe Institute. The data set that we'll use to test this comes from the London Stock Exchange, just around the corner. I was, in fact, visiting there on Tuesday afternoon, trying to wheedle some more data out of them. They actually, unfortunately, changed the data format on us. But this is the screen that, for a mere 50,000 pounds a year or so, you can get that shows you at each level in this limit order book, each price level shows you how many shares are sitting there. And so in London, you have a completely transparent market. where everything is electronic since 1998, so we can see every action by every trader on every stock, making a database of 350 million events over a 4-year period. And so we can then use that because we can actually measure directly these order flows. We can, and here's an example of the sort of data that we get. This is Shell Oil Company plotting time on this axis. This is 2002 against price on that axis, and the color code represents the supplier demand, the volume in my previous picture, stored at each price level. So the orders to buy are the ones down here below this kind of yellow curve. This, for example, somebody places an order to buy at this price level and actually sits on this order to buy for months. And then eventually it's executed here, because this bright, and I should say, so the scale is that black means not very many shares there, white means no shares at all, blue means a few more, red means a whole lot, and green or yellow means something in the middle. So you can see that most of the supply and demand is concentrated in this random walkie looking curve, which is where the transactions are actually taking place, the interface from our point of view. Shares, things above that curve are orders to sell. And the reason I say it's an interface because it's the collision between buying and selling in this concentrated region of supply and demand that's actually making the transactions happening and actually causing the price to diffuse around. So just for the heck of it, I show you here the same thing, only now on a daily level. This is 1 day's worth of stuff. You can see this sort of boiling region in the center where things are happening very fast, and you can see as you move away, the time scales are rolling out. So there's certain regularities in this picture. Part of why I'm showing it to you is right away you just start looking at this data, you automatically start seeing certain regularities, and we're both trying to make this random model and sort of characterize these regularities. Now, just to review the model that I mentioned a moment ago, it has 5 parameters: the limit order rate, the market order rate, the order cancellation rate, which we call order flow rates, and these turn out to be the really dominant things. And then it turns out a 4th parameter is a typical order size. The discreteness, the size of the snowflakes matters. Great big snowflakes are different. A beach with fine grains of sand is different than a beach with billiard ball size grains of sand, and tick size. Now, okay, and as I said, all these can be decomposed into these 3 fundamental dimensional quantities of shares, price, and time. Now, bearing these parameters in mind, we make some predictions. So, for example, we predict that the typical size of the spread, that is the distance between the best bid and the best ask, should be the ratio of the market order rate to the limit order rate times some very simple function, a non-dimensional function of the following non-dimensional combination of parameters: order size times cancellation rate divided by market order rate. And we actually can derive that from mean field theory. On this plot here, what we show is the predicted value of the spread against the actual value of the spread, where what we've done is take 50 stocks, take about a 2-year period, and measure the average values of these parameters over this 2-year period. So we're not making a prediction like saying the stock tomorrow is going to have this or that spread. This is more in the vein of, say, the ideal gas law, where if you take a container of gas, and if you know, say, the temperature and volume of the gas, you can make a prediction about the pressure knowing the ideal gas constant. And similarly here, we have theory that tells us that measuring these parameters, we can predict what the spread will be across the same period. And so we plot the data against each other. These are actually like here's Shell. These are the names of 50 different stocks in our data set. You can see that they roughly cluster along a line. The slope of the line is very close to 1, as it should be. If the prediction were really ideal, they would all cluster along this diagonal here. And what we see is this is a log-log scale, rather faded log-log scale, I'm afraid. And so there is some offset. So there's an overall error in the scale, but the basic scaling relation is captured. Similarly, through simulation, we weren't able to get this from mean field theory. We find the following rule is a good rule for the price diffusion rate, or the volatility. That is, what you see is the volatility should scale as some non-trivial ratio of, again, market order rate, cancellation rate, order size, and limit order rate. And once again, we see the data clustering along a line. The line slope's actually a little greater than 1, indicating the scaling relation isn't quite right. It's in the ballpark. And once again, we have some problem with the scale. Let me just then present the third thing the model does well, and then I'll start talking about some of the things the model doesn't do well and some of the empirical characterizations that we're trying to make. Another thing that's of considerable interest to us, it's of considerable interest to anybody who actually trades in a financial market, is market impact, which tells you when you try and trade, how much are you going to move prices. So in this case, we'll define it to be the instantaneous change in price caused by the price immediately after an order arrives minus the price immediately before an order arrives. And so, just to remind you, when an order arrives, like there's an order arriving, we start with the best ask price there. We see a shift in the ask price, and that's the market impact. So, if we just plot this by just taking the order size in some units like British pounds, and we look at the price shift as a difference of log prices, we see a bunch of different curves for each stock. But if we plot the same data in the non-dimensional units dictated by the model, so we take the number of shares and we multiply the number of shares by the order cancellation rate and divide it by market order rate, which gives us a non-dimensional quantity relating to the number of shares. And similarly, we take the price shift that we measure and we multiply it by the limit order rate over the market order rate, then we see these data for these 11 stocks collapsing onto roughly the same curve. Illustrating that we now understand something, thank you, about what is influencing price formation, even though we got it in a kind of backhanded way, because I'll say, this is the first thing I'll say, the model, while it produces curves that look kind of like this, they actually fluctuate as the parameters are varied too much. So the non-dimensional units of the model actually pick up on a regularity that the model itself literally doesn't capture as well as one would like. Now, I put this up here. Many of you may not know that, at least according to a Russian friend of mine, Russia is the only country where the most popular website is not a porn site, it's actually a joke site. And we made on October 23rd, this is actually the abstract of our paper in Russian. You can see my name sitting in the middle. And I guess when, it was actually Philip Ball wrote a little Nature news piece, and it got picked up. The Russians thought this was really funny, and the reason they thought the abstract of our paper was so funny is because apparently somewhere in there it says that we model traders as being more or less complete idiots. And so I want to just say that, well, yeah, I have known some traders that I did think were more or less complete idiots. I don't think that in general. I mean, I think intelligence is important. I don't want to argue that you can understand everything about a market by just assuming that traders do nothing but flip coins. They are processing information and incorporating that information, and it's very important to try and understand how that works, which motivates the rest of the talk. I'm actually going to skip that slide because I'm short on time. But there are a lot of regularities that the model that I just presented to you doesn't capture. Like, for example, I showed you this volatility plot where we saw there were long runs of volatility, where one of the interesting things about that is volatility is heavily autocorrelated in time. A big price move today doesn't say anything about the sign of the price move tomorrow per se, but it does say that we expect a large price move tomorrow. And actually, if you take the autocorrelation function and plot it on log-log scale, you see that the tail is a straight line. There's a power law tail. It's a very interesting question. Why should that be? It's also well known that price fluctuations have fat tails. That is, the probability that you see a price return greater than a certain threshold goes as that threshold to a negative power. And this is something that Mandelbrot discovered back in the 60s. that's generated a lot of interest in the physics community, and there must be, I don't know, 15 or 20 theories for why this is true. And let me just show you a picture of what that data looked like. This is actually an average over 10 different stocks, and we just plot the logarithm of the probability that a return is greater than a threshold against the size of that threshold, and the observation is a region where it seems to be roughly a straight line. So these are the kind of things that we would like to understand. And so now we're going to work the problem back from the other end. Instead of starting with a model, we're going to work it back from the data, asking what is the kind of key thing that's driving this fat-tailed phenomenon. And here are my collaborators, Sabal Shmike, another graduate, and Ananda Sen, 2 graduate students at SFI, and Fabrizio Lillo, who's now actually a professor at University of Palermo. So the first thing we did was to take the same curve I showed you a moment ago and segment the data by what seemed to drive the return at the individual event level. So we take each price change and we ask what action triggered that price change. And so we looked only at price changes triggered by the arrival of market orders. So the market order hits the book, causes the bid or offer to move some way, and then we segmented up the data into 5 groups based on the size of the order that hit. And what we see here is there is some variation from curve to curve. We're now conditioning on which of the 5 groups of order size, that's V up there, caused the event to happen. What we see is we see a very similar distribution for all 5 groups of events. And furthermore, these aren't even in the order you might expect. There's very little tendency for larger orders to cause larger price changes, which is a puzzle, because you would have thought that you could explain this by just saying, well, you have a big order. The big order is going to penetrate the book a long distance, cause a big change. But that doesn't seem to be what's going on. And instead, when you look, you go pick out the big events, and you say, you look at a movie of what's happening through these big events. And here I show you 2 frames from such a movie. So again, here you see the sell orders. This is a real limit order book. This is from the stock AstraZeneca. These are the buy orders. And this is one event, and this is the subsequent event. And so you see, looking at that book, it's interesting that the best ask, you see an order sitting out there all by itself. Then a market order arrives and knocks that out. Turns out it knocks it out exactly. Why? Because these guys are actually looking at the book. This is one of the signs of intelligence. They're looking at the book. They take that order out, and this is what the book looks like immediately after. So there's a large price change. Why did it occur? Because there's a big gap in the limit order book. In fact, it turns out you can define in the book, we'll call that the first gap, the gap from the best to the next best, and then the second gap, and the third gap, and so on. And all of these gap distributions scale in the same way, and they all scale. This plot is actually showing you price moves here and distribution of gap sizes here. So the distribution of price moves in the book just precisely reflects the distribution of gap sizes in the limit order book. So it says that whatever's going on is actually driven by liquidity. It's by how many available buyers and sellers there are, but actually it turns out it's not the number, it's the way in which they cluster their orders in the book. And in physics jargon, it's interesting to us because it's a finite size effect. It depends on the fact that there are a finite number of orders in the book. And it's the granularity of the medium, the fact that there are actually holes in this book that seems to be the responsible cause. So this plot here is just showing you that if you look at different stocks, plot's not showing you much actually because the display is so faded. So I'll skip it in the interest of finishing on time. So what we're trying to do now is build a better empirical model for real order flow, working the problem backwards. And so we've noticed a lot of kind of fascinating regularities in what's going on inside this limit order book. For example, again, one of these log-log plots, we're plotting the probability that somebody places an order a given distance from the corresponding best price. And what you see is, again, there's a region out here where there seems to be a straight line. It's once again a power law. We show buy and sell orders separately, they lay over each other across almost the whole range. In fact, if you look at a typical British stock, it's worth about 20 pounds, has a tick size of about a pence. In measuring this in ticks, we see all the way out to about 2000, we see these curves agreeing. That is all the way out as far as we could hope they could agree, given the asymmetry between buying and selling. Another kind of fascinating regularity, and this is a bit in the vein of Jeff's, there are all these power laws around, and where do they all come from? I mean, everywhere you look in the market, you see power laws describing what's going on. This is another one. We look at the signs of orders, make them +1 if they're buy orders, -1 if they're sell orders, and then just take an autocorrelation function of this series of plus and minus ones. And again, we see, roughly speaking, a linear region in this curve. It gets very noisy out here because even though we have 1 million events in this series, this regularity goes all the way out to 10,000 events. So that is, we have a positive autocorrelation function all the way out to 10,000 events. Furthermore, the exponent of this power law is less than 1, which means that this autocorrelation function is non-integrable. The integral is infinite, illustrating it has long memory. That is, events in the far past have a substantial influence on the future. I'm going to skip that and just conclude by talking about where we're going. Again, another thing our model doesn't do quite right is that the model contains arbitrages. Our model, with the random order flow falling out of the sky, well, it's like a world, in better financial economics jargon, of random liquidity demanders. Those are the guys that randomly place market orders, people that randomly say, gee, I need some money now, I need to unload my stock position for some reason that's unrelated to what's going on in the stock, and random liquidity suppliers. This world gives rise to arbitrage. That is, there are things like negative autocorrelations in prices, asymmetries in the order book, market-making strategies that can be used to exploit the system. So we're trying to build up, and I hope soon to have some results to present on this, adding intelligence to try and see what's going on. And this is exploiting an analogy that is close to my heart, that markets are a lot like biology in that we have variation. People are constantly trying out new strategies of various sorts. The ones that are successful get selected. The ones that are successful get propagated through time, either because the same person goes on using them or, somebody moves to a new firm and trades in there. And this is one of my observations from my time wandering around Wall Street with a suit, that you go to different trading firms, there's a very diverse ecology. I mean, people use very different strategies in different places. Diversity plays a big role. This diversity, I think, is poorly studied, but I think one should be able to characterize the typical strategies in markets and build, both maybe explain why those strategies exist, and their existence may be very important to really understanding what goes on in a financial ecology. So we're building up a model where we view the liquidity demand as food for arbitrageurs who are like predators in an ecology of arbitrage, where we both wire in agents by hand for things like market makers and agents that exploit order imbalances or do technical trading, and then we look and we see how does that affect the properties, the statistical properties of the market as we let these agents evolve and be selected. Can we show that we get a better fit to the data? Let me just say there are some practical implications for this. Prediction company, for example, places like that, understanding market impact, understanding the spread is important for trading tactics. You might say want to design an automated market maker. It's a very active topic in the financial community these days. Or for regulators for market design, you might want to ask, say, can you reduce volatility by putting incentives on patient order flow and charging for impatient order flow, which our formulas say if you can change the order flows by X amount, we can predict how much it should change volatility and spreads. And you can also maybe use this to detect poor markets by seeing which markets lie above or below the kind of scaling law curves that I showed you a moment ago. So to conclude, we found some partial solutions, and I'll emphasize partial, to some classic problems. They're partial solutions because we did it by dividing the problem into two parts. Rather than trying to do things from first principles, we first tried to understand how order flow affects the market, and I think we've made a good start towards understanding that. And then worrying about what determines order flow. We haven't even begun to study that. But it's a divide and conquer strategy, and whenever you can divide a problem up into pieces, it's always a good idea. We have the advantage that in the model, the parameters are all directly measurable, so we can actually go out and test the theory in a fairly unambiguous way, which, as I mentioned before, is one of the major problems, in my view, with most equilibrium models of markets. They result in theories that are actually very difficult to test properly, and hence difficult to falsify. Part of what we said is that it's liquidity that's really the important driver of price formation, and this liquidity is modulated. Key parameter is market order rate, which indicates impatience. High market order rate would indicate impatience. A high limit order rate would indicate more patient behavior. Order cancellation rate being high would indicate impatience, or low would indicate patience. And so it seems that whatever information arrival is doing and however it's affecting the market, and it certainly is, that a key aspect is whether it's making people more or less patient. I hope I've convinced you that it's actually important to understand the dynamics of the market institution itself. In a sense, what we've done is throw random stuff at this black box, which is the continuous double auction algorithm, and look at its response function. So it's very much the way an engineer would go about trying to understand the components in an engineering system. And at least as a start, maybe it makes sense to look at zero intelligence models, and if nothing else, our goal now is to add the intelligence incrementally and try and pin down exactly which statistical properties of the market depend on the actual intelligence or other aspects of the agent behavior. So on that note, I'll end. Thank you.
Excellent. Thank you very much indeed. And that's a glass.
Thank you.
Thank you very much. Now we do have time for a few questions. Yes, Scott.
It seems like the ratio of limit to market orders would be a really defining characteristic, and maybe it's somewhat sensitive to the difference between institutional investors and individual investors to try to go to actual markets for information on that to make your model more real.
Yeah, so first of all, we're looking at this 350 million of that data set for the London Stock Exchange. And let me mention first that there is a kind of conservation law associated with that, because if the book is neither building up nor shrinking, then for every order that flows in, an order has to be flowing out. And so the conservation law is that on average, the number of market orders equals the number of limit orders, the number of limit orders equals the number of market orders plus the number of cancellations. And so in fact, the number of limit orders is pegged right around 50%, and the number of market orders and cancellations tends to trade off. Now we see variations in the size of those orders, okay, and we also see variations in the density with which the orders are concentrated. And in fact, when the market gets volatile, the orders tend to spread out across a larger area, and when the market gets less volatile, they tend to be concentrated more at a central price. And this is one of the key elements we're trying to capture in our more refined model. Now, the other feature that this data set has that we've just begun to exploit is that we actually have little codes for the participants. And this is what I was arm wrestling with the LSE about on Tuesday, because they've stopped providing that. So we're lucky because we have about 4 years of data, where with some clever unscrambling by Marcus, because they actually scramble them once a month, but he quickly figured out, being a good hacker, figured out how to fix that. We can actually track over long periods of time in some cases who the participants are and break it down. Now, we don't know because all we have are numbers, so we don't know who's institutional and who's not. And while there is a code that in principle tells you whether a trade is for an agency or principal, in fact it's violated so often I'm told that it's meaningless, but we can actually see the behaviors of the individual participant codes. And it's quite fascinating because what you see is the different participants in this market are all doing really different things. And so there's this fascinating level of diversity, and you know, we're just basically overwhelmed with data because we've been in plotting this data, and you know, you see everything you look at, you see some amazing, well, why in the world is this guy doing this kind of story? So we're trying to document this heterogeneity and make use of it going forward in our model. One thing we have shown is, for example, the long memory, that half of the agents' order flow by themselves displays the long memory, or not half, but some participants you see at a glance, their order flow is highly long memory. Other agents don't show it at all. And so that gives us a little clue about what must be causing the long memory. What the clue really says yet, we don't know.
Come in front of me so that
Okay.
I don't
Well, I think I'm tall enough that I don't think that's a problem.
Yes, there's a question there.
Yeah, it's partly a difficult remark, but might this not be more useful in detecting insider trading? Sort of exactly the reverse of what you intend to do with it.
Yeah. Now, insider trading, the symptom of insider trading is that you should see a price movement before a news announcement. And so that's the most useful way to spot insider trading. I think what it might be able to spot, and I'm actually initiating some dialogue with the New York Stock Exchange. In the New York Stock Exchange, let me actually back up and say the LSE, it's sort of a free-for-all. There's no designated official special market maker for any given stock. You can just get in there and place orders to buy or sell, and it's all transparent. The New York Stock Exchange, in contrast, there's a government monopoly. The government gives the monopoly to different players. They're called specialists. And the specialists have a regulatory obligation to make a, quote, orderly market. So, for example, they're not supposed to let the price move by more than a few ticks at a time. They're supposed to step in front and place orders. Now, if we could get access to the kind of order flow data that we have for the London Stock Exchange, we could make those same scaling plots that I showed you for the spread and for the volatility, and then we could look and see, well, who's below the curve and who's above the curve? Because the problem is, you know, absent a benchmark like that, if you come into a specialist and say, gee, your spreads are awfully high, he'll say, well, that's because my volume's so low, or it's because my volatility on this stock is really high, or it's because, you know, it's this kind of a stock, and you know, this is a very unusual, they have a story. But so if you can provide a benchmark that scales out the things, scales out some of their excuses effectively, then that might be quite useful to the SEC. So that's our thought along that line.
Thank you very much indeed.